that I picked up on the budget. The one was where the Minister talked about municipalities being the cold face of delivery, and also mentioned the fact that the service delivery is bad. A number of them are experiencing weakness in governance and financial management and service delivery, and they focus on tightening the budget process, ramping oversight, increasing skills and capacity. For me, that's so critical, and I think there should have been more on that and more on the implementation of what's happening. And I think everyone knows what's happening in the city as far as that is concerned. The second issue that was very striking was the fact that they talked about computers being purchased, 1.2 times or 2 times the normal price. And he said as government they should have actually got it less than the normal price as such. And for me, it's all the measures that they've taken for paying for items coming across, and that's a major issue as such. I think from Amal's side, we've been an organization that's running for some 40 years. It's an association of accountants and lawyers. It's one of the unique organizations. We've arranged for courses and presentations over the years, and I think it's more relevant now than even before. When you have a look at some of the things that we're doing, for example, the sukuk that was issued last year in November for 20 billion, it comes on the back of Sharia compliant instruments, etc., which institutions benefit from. So Amal is open to everyone. It's not just for the Muslims. The membership fee is 300 rands a year. So please, if you are not a member of Amal, and I'm sure Minara will talk about their membership a bit later, but please join. And if you can provide assistance, please do. MS Farak, I know you're a member of Amal. I know you are a paying member, I can confirm that. But we also need your time and resources, and perhaps you can also kind of assist us. With that, thank you very much, and thank you for joining us at this session. Thank you.
Thank you, Shabir, for that official welcome. Indeed, guests, in the interest of time, it gives me great honor and privilege to welcome our esteemed keynote speaker once again, who is no stranger to us, Ms. Yasmeen Suliman from Bowmans, who, as we know, is a distinguished expert in her field and brings a wealth of experience and contributions to the tax field, including shaping legislation for Islamic financial service products. She is a qualified chartered accountant with master's qualifications in financial accounting and taxation. Please join me in welcoming Ms. Yasmeen Suliman, who will be providing us with valuable insights and perspectives on the 2024 budget speech and the implications for our broader economic landscape. Ms. Yasmeen Suliman.
My enthusiasm would be nice. Assalamu alaikum, everyone. Nice to be here again. I'm keeping count. This is my 16th year. When I started, I didn't need reading glasses. All of you look a bit hazy because I've got my reading glasses on now. So I think I need to start my... So it is an election year, and the question is, usually in an election year you don't hear much, you don't see much. There's a lot of populist sort of proposals that come through. And I think there was a lot of speculation as to whether that would be the case in the current year. I think overall, before I get into the detail, I'd like to say that Treasury has really walked a fine line. I don't think all their decisions are popular. I don't think everybody agrees with them, but I think they did the best with what they could. I think it's the first time in a long time that I'm not overly critical of Treasury. On the tax front, there's certain things that they've proposed which are controversial, and you'll see when I get to them that actually could have some wide-ranging impact. But overall, I think they did the best with what they could do. I think they steered clear of making any big sort of populist kind of choices. If you think back on previous election years, they talked about fees must fall, free education for all, increasing the social grants and so on. Yes, there are increases for the grants and so on, but not over the top, within affordability. And I think it's commendable, especially since there's speculation that the current government is probably not going to be a majority-led government in the future. So the fact that they resisted, taking the popular choices and maybe hurting the fiscus even more, I think, is to be commended. So I'm just going to paint a brief economic backdrop. I'm not an economist, so it's just very briefly what it is that the economy is looking like at the moment, and then against that we can paint the picture of what tax proposals would look like. So from an economic point of view, I mean, this has been the story for many years now. I think for at least the last decade, economic growth is tapered at best. The growth expectation for 2023 is 0.6%. That's barely enough to generate any jobs, any significant jobs, to absorb unemployed workforce. What is expected is an average growth rate of 1.6% in the medium term. And unfortunately, Treasury in this respect has always been over-optimistic. So if you look back at the projections of the last few years, it's always overpromise and deliver as far as growth goes. Unfortunately, it's a pity because 1.6% is not really a huge amount. When you look at what it was in the past, you can see that big dip in 2020, but it's not like we've really, we've really recovered compared to other economies. And I think, our problems, and the economist that I heard this morning, essentially what he said is a lot of our problems are based on, stem from own goals. It's not really global factors and things like that. It's things that we are not doing right as a country that's causing the problems, not outside factors. In terms of risk to the economic outlook, they remain elevated. From a global point of view, we all know there's the conflict in the Middle East, the consequences for the oil price, what it could mean for our transport systems and so on. If China falls, our economy may go with it because it's our biggest trading partner. And global inflation has been high, at historic highs in fact. In some countries that never had inflation before suddenly have had quite significant inflation in the last few years, well, in the last year or so. But the main risks are really around the domestic side. The fact that we can't get our infrastructure to work properly, basic things like electricity, rail, ports, things that were working in the past, somehow through disrepair, disuse, and to be honest, a lot of corruption has just fallen down into disrepair. We've got high sovereign credit. Our debt to GDP ratio is very high. It's too high for the kind of economy that we do have. And one of the problems is that a lot of the money that we do raise goes towards servicing that debt. So out of every rand in revenue, 20 cents goes towards paying interest. So it's not really adding to, productive expenditure. It's too high. And when you see the interest bill, you think to yourself, there's a lot to be said for Islamic-based principles when it comes to running an economy. Because interest in itself doesn't really add much in value. And then we've got the high domestic interest rates that persist. And then we've got load shedding that's going to continue in the near term. So I don't know whether it's going to get any better. Certainly, every time you get positive, suddenly stage 4 comes back. You'll have the budget speech and stage 5 comes back, that sort of thing. So it's very difficult to plan in advance. There was at one stage in December, you thought, okay, well, we're back to normal now, but it was short-lived. In terms of where the money is going, so we're consistently spending more than we generate. So there's always this deficit. As I told you, 20% of our spending is on interest costs. So that's a big chunk already taken out of what is available. And then a large chunk of money has been devoted to social services. So education, health, community development, and social development. So your grants, basically, giving back to society. So there's a lot of expenditure that's happening. The question is whether it's value for money. Certainly, I think a lot of our, and I know, look, I'm speaking, it's my personal opinion, I don't think we necessarily get value for money for government spending. And I've said it for many years. And this year in the budget review, Treasury seems to confirm that. So one of the things that they published in the budget review this year is they said the multiplier effect for spending is less than 1 for government spending. So for every rand that they spend in government, less than 1 rand adds to the growth or the economy of the country. So it shows you that actually it's better if the government actually don't spend. So having given you a whirlwind tour of the economic backdrop, what do the tax proposals look like? Now, going into the budget, there's a lot of media reports and so on about there being a shortfall of 15 billion rand. And there was a lot of speculation as to where that 15 billion rand going to come from. Some speculated on a VAT rate increase, some speculated that there was going to be a fuel levy increase and so on. Two deeply unpopular proposals for an election year, primarily because it's regressive. So it impacts your poorer part of the population far more than it impacts the richer part of your population. So it's very deeply unpopular. So most commentators said, look, it's a possibility but unlikely in an election year, and that turned out to be true. So in terms of where the revenue will come from in the current year, they expect the bulk of the revenue, or the biggest chunk of revenue, to still come from personal income tax. If you compare us to other countries, this is unusual. This graph is unusual. In other countries, the biggest contributor to the tax take is actually VAT, not personal income tax. South Africa is an outlier in this particular area. If you compare to the previous year, so in the 2024 year, it was about 640 billion rand was collected for personal income tax. So they expect 100 billion rand more to be collected from personal taxes in the next year. Right? So basically, milking the taxpaying public. Right? That has seen some challenges. I think primarily because of large infrastructure projects. A lot of them are still in development phase. So in the development phase, they're just basically taking up refunds at the moment rather than generating outputs. So that is one of the reasons why our VAT collections has been a bit depressed. But in time, once the infrastructure projects come online, that should stabilize. In terms of personal taxes, here I'm sure you saw the media reports. There were no changes to the tax brackets. So effectively, from the fact that when a person gets a salary increase and moves into the next tax bracket, they're going to have to pay an additional or higher rate of tax. That's where all our additional tax money is going to come from. So just by simply not adjusting for inflation, for fiscal drag, they're expecting to get an additional 16.3 billion rand in the next year. So the big chunk of the 15 billion rand shortfall they wanted to fund is actually coming from us normal individual taxpayers. The rebates and thresholds remain exactly the same as last year. And if you think about this particular proposal compared to a proposal where they increased the VAT rate or increased the fuel levies, this is a bit more palatable because it's not actually increasing your tax. It's only with a fraction of time and you're moving up a salary bracket that you actually will have more tax to pay. So it's not increasing the rates, it's just because of inflation. So it's not an obvious kind of increase. Whereas an increase to VAT or an increase to fuel levies would be an immediate and more drastic impact. In terms of the statistics, who pays the tax? So if you look at a population of about roughly 70 million people in the country, only 14 million of them are registered taxpayers. Right? Of the 14, only 7.4 million pay any tax. That percentage has improved from last year. So last year it was only 8.5% of the total registered paid tax. It's moved up to 52%, so a bit of an improvement, but still a very narrow base. And if you think about this base of 7.4 million, they pay 738 billion rand in taxes. So it's a lot of reliance on a small base of taxpayers. With regard to taxpayers earning over 1.5 million rand a year, so those at the higher end, more the 45% tax rate level, there's only 198,000 individuals in that category. And that 198,000 fund basically 32% of all personal taxes paid. Now think about this category of taxpayer, they're a bit more mobile, easy for them to up and go, easy also to diversify. And the last year, we've seen, personally, we've assisted quite a few taxpayers exiting from the tax system in South Africa through ceasing to be resident here. So, it's a kind of base that while it's here, it's good, but it's also quite mobile, and people do move quite easily. Then in terms of other proposals that impact personal taxes, the medical scheme credits didn't change, so it's exactly the same as last year. The good news is that we still have it. Because remember, the proposal was that as soon to fund NHI, the medical scheme credits would be removed, which would have quite a big impact on taxpayers, and the amounts of tax that needs to be paid. So it's good news. It hasn't been increased, but it hasn't been removed either. Because of not adjusting for inflation, they expect to get an additional 1.9 billion rand from this category alone. So it's quite a significant amount of money they expect to raise just from not increasing for inflation. Then the two-part retirement system, we've spoken about this one before. It's been in sort of the development for a few years now. And essentially, it's the reform of your retirement funds and to enable contributors to retirement funds to access a portion of their funds while they're still members. Traditionally, you'd have to resign as a member, withdraw your funds, and it basically erodes your retirement savings. The idea is for members that are in distress, that need funds, can still access a portion while still protecting the bulk of it for retirement. Right? So it's a bit of a compromise position. The first phase is expected to come into effect on the 1st of September. Hopefully it does come into effect now. And the idea is that some of your existing savings will be reallocated to what they call the savings pot. So the pot that is able to be withdrawn, so they call it the seed capital. So those amounts will become available from the 1st of September onwards. Now the expectation that Treasury has is that quite a few members of retirement funds will access those savings. And they expect that because of that, they will be generating more in tax revenues. They expect to get about 5 billion rands from withdrawals in the next year. So on the one hand, it's a good thing, that members in distress would have the ability to access some of the retirement funds without necessarily leaving the fund. But it does mean there's going to be quite a big, or we expect quite a significant outflow from retirement funds in the short term. Then from an employment perspective, the employment tax incentive, as you know, is there to incentivize particularly youth employment. There's been quite a few schemes over the last few years, particularly the ones where an employer can pay for a person, a youth, to be trained full-time and claim that person as an employee and claim ETI on that person's stipend. Right? So there's quite a few of these schemes. We've got two clients who unfortunately didn't ask for advice before they implemented it and are now in trouble with SARS that we're defending. It's very difficult to defend it. From a SARS point of view and from a Treasury point of view, there was no ability for them to actually impose penalties on these abusive schemes in the past. So the idea here is for them to put in punitive measures into current year legislation to combat these abusive schemes. Then some good news on the learnership front. So learnership allowances were meant to come to an end in March this year. It's been extended by a further 3 years to March 2027. So this is good news. I've got lots of clients that make use of the learnership allowances to train their staff. And I think it's been a good way to upskill, employees. So National Treasury plans to use this extended period of time to evaluate it, the incentive, and decide on its future. I suspect with the success that it's had, it's going to this incentive is probably going to be retained in some form or the other post 2027. Then, from a payroll point of view, an amendment, a benefit to employees. So currently, if an employee has to refund certain remuneration to the employer, they have to make that refund gross of tax and only claim the tax deduction on assessment. So for example, I go for maternity leave. Inshallah, it never happens. I don't want to have another kid at this age, but just as an example, go for maternity leave and then decide I want to leave and I have to pay back my maternity leave salary back to Bowman's. Right? In that case, when I pay back Bowman's, I'm expected to pay my gross salary back to them, and then through the tax return, claim back the tax overpaid. Now, obviously, from an employee point of view, to fund the amount you never received is quite a difficult thing. So the idea, the change that they want to make is that amendment must be done through the payroll so that the employee can get an immediate benefit by the payroll system instead of waiting for for their return to be assessed. Now, the reason why SARS is moving in this direction is because they are moving towards more real-time reporting for tax. So at the moment, PAYE, you do biannual reconciliations. So in August and in February every year, reconcile all employees' information and send that through to SARS. The idea going forward is that to be done on a monthly basis. Right? How that's exactly going to work, I don't know. But it's in keeping with other proposals that they've made with regard to that modernization as well. They want to have access to systems, taxpayers' accounting systems, so they know when you issue an invoice, when you receive an invoice, they can estimate how much of that you should be paying and so on. Not unusual, other African countries have implemented similar systems. So it's moving in that direction where they want more sort of real-time information. I think primarily to police the people that are on the register even more closely. Hopefully they spend more time finding the people that should have been on the register in the first place, and I must say. Then with regard to trust, not too many amendments this year, but one that is relevant for foreign trust. So remember that trusts are taxed at a rate of 45%. That hasn't changed, so it remains the same. The one area that they want to tighten up on is loans to foreign trusts. And remember in Section 7C, this is the provision that deals with donations tax on interest-free loans or low-interest loans to trusts and companies owned by trusts. Now currently, if a loan is subject to the transfer pricing provisions, so it's a foreign denominated, a loan to a foreign trust, and the transfer pricing provisions apply to that loan, Section 7C does not apply. The concern is that the arm's length rate for transfer pricing purposes could be lower than the official rate of interest. So the idea is, at a minimum, they want the official rate of interest to be charged, and if that rate is at a lower rate, I think what they want to do is subject that differential to Section 7C of the Income Tax Act. So something to be aware of. I suppose it's relatively unusual, but we do have in our community quite a few guys that do have foreign trusts, so it could be relevant there. Then with regard to wealth taxes, quite a few different wealth taxes that we do have. None of them have changed much, so the rates remain the same for CGT, estate duty, donations tax, transfer duty, and securities transfer tax. Then on the corporate tax front, so one of the things that was quite unusual for an election year, if you go into the detail of what was contained in the budget review, what was unusual in the current year, which we don't usually see in an election year, is that there was a lot of technical amendments, a hell of a lot, you know. Usually election year is regarded as a short legislative year, so Treasury tries to keep the amount of technical amendments to a minimum, just because of practical difficulties of getting it through Parliament and so on. The time for consultation is reduced because of the disruption to Parliament. This year, and you'll see it on the website as well, there's a host of changes for corporate tax as well as that's being proposed, which is unusual for an election year. Some of the big changes, which I'm not really talking about today, which you may read about in the media, is from an international tax point of view, the implementation of the global minimum tax, but that's going to apply to companies that have groups that have turnover of more than 750 million euros. So you're really large corporates, so I don't really want to talk too much about that today. And then there's also incentives for investment in EV production, electric vehicle and hydrogen-powered vehicle production that's going to come in from around 2026. And the investment allowance that they're proposing is 150% deduction on all the assets, the cost of the assets to manufacture those kinds of vehicles. So something to be aware of, but I don't think it was really, worthwhile to speak too much about it today. On the corporate tax front, the few proposals that I want to talk about is related firstly to renewable energy. Remember last year there were two big announcements. One was related to the renewable energy or the solar panel deduction for individuals. And then the other one was the deduction for renewable energy for businesses. The one for individuals is coming to an end on next week Thursday, on the 29th of February, and from the looks of it, will not be extended. Right? So if you're going to install panels on your roof, and you need to install it and bring it into use by next Thursday. So that's And that's the tax planning. Ask Al-Baraka for a loan, I'm sure it'll be quick and easy to get. Right? So that's for individuals. For companies, for businesses, there's still another year to go. So the idea is for renewable energy projects undertaken by businesses, and it's not restricted to solar, it could be other renewable projects as well. On those assets, 125% deduction is available in the year those assets are brought into use. The sunset date for that is 28th of February next year, so businesses still have a year to go. And some of these projects do have a long tail to them, so if you're planning one for your business, plan for sooner rather than later. The nice thing about the allowance for businesses, though, is that it's not restricted to the panels only. It's the whole system, the inverters, the batteries, everything, right? Whereas the one for individuals, I don't know why, but they only wanted the solar panels to be incentivized. Right? So that was last year's proposal. It does not seem like that business one is going to be extended any further, so beyond 2025. But what the proposal is to replace it, is that what we do have in Section 12B, and it's been there for a few years already, is 100% deduction for certain solar installations. And any installation that generated less than 1 megawatt of electricity, you could get 100% deduction in year one. So what they're looking at is maybe increasing 1 megawatt to a higher number. So increasing that threshold. So on those kinds of assets, you get a once-off 100% deduction. Not as attractive as 125% deduction, but nothing to sneeze at either. So that's what it looks like they're going to replace it with. Then currently in Section 12B, there are some limitations for lessors of these solar systems or renewable energy systems. So if you're a lessor, in certain circumstances, you do not qualify for the allowances. The idea is to relax that somewhat so that it allows for various financing arrangements for these renewable energy projects. Then the assessed loss restriction. We're already into the first year of the assessed loss restriction coming into play. Remember, this is the one that applies to companies. The use of the assessed loss is limited to the higher of R1 million or 80% of the taxable income. Now, what was pointed out to Treasury is that when a company is in liquidation, when the process of being deregistered, this limitation is actually quite unfair because they actually can't carry it forward. Right? So what Treasury is considering is to relax the 80% rule for companies that are in the process of winding up, which is quite nice because the last thing you want when you're winding up a company is to have tax payable because you can't utilize your assessed loss brought forward. Right? So it's quite a nice change. Then from a withholding tax perspective, these rates remain the same. There were no amendments for dividend tax, royalty withholding tax, and interest paid to non-residents. Now getting to the VAT. So now on the VAT side, there were a number of proposals. I'm going to just pick up the ones that I think are relevant for this audience, the more controversial ones. For me, the two big ones are on this slide. The first is related to the zero rating of fruit and vegetables. So currently, in the Schedule 2 of the VAT Act, fruit and vegetables are zero rated, provided that they sold in their natural state. So you can preserve them in their natural state, then those still would qualify as being zero rated. What the proposal is that if these fruit and vegetables have been prepared in any way, so if they've been pre-cut or prepared, unfortunately, that zero rating should fall away. There was a similar proposal maybe about, 6-8 years ago. It was a bit different from this current proposal. The proposal at that time was that what the Treasury was upset about is that if a rich person buys fruit and vegetables, they benefit from the zero rating, same as a poor person does. So the idea there was that if you buy it from a Woolworths, you wouldn't get the zero rating, whereas if you bought from a corner shop, the zero rating was there. Unfortunately, that didn't come to pass. They saw the light and they didn't pass that amendment, but that was the thinking. It seems to have come back in the current year. Now, how it's been framed in the budget review is as a clarification that the zero rating does not apply to pre-cut or prepared fruit and vegetables. Now, if you think of the kind of fruit and vegetables we're talking about all your mixed vegetables that are frozen, the frozen corn, your frozen peas, chips, anything fruit that's cut up, in those little punnets, things like that, or your stir fries that are sort of cut up cabbages and all that sort of thing, that haven't really been changed beyond the fact that they've been cut up into convenient sort of packages and into convenient shapes for consumers to use. So, look, I mean, it could end up being that it's going to be a lot more expensive to buy these kinds of products going forward. So I think a lot of people are probably going to revert to whole fruit and vegetables. We're going to see a big knock in maybe companies like Woolworths and Checkers, where they have these kind of prepared foods, kind of fresh foods available. And I think it's going to have some unintended consequences for the man in the street as well. The one I thought of was, well, actually two. If you think of a vendor on the street that sells fat cook with chips, the chips that they normally use are frozen chips that would qualify for zero rating currently, immediately we're adding 15% to their cost. Right? What about vendors that sell, there's fried up sweet corn? Usually they use the frozen packets of sweet corn, cook it up on the scuttle, and they sell it in those little cups and so on. You've added 15% to their cost as well. So it's not only the well-off that are going to be impacted, it's also going to be people that are using these kind of products to make a living as well. So hopefully, some sanity will prevail and they will stop this particular provision from going through. The other one that's very interesting is related to VAT input claims. So remember, if you don't have your tax invoice before your input in your current period, you've got 5 years to claim it back. Right? So you can put it into any period in the next 5 years. And in fact, quite a few vendors do roll their input VAT because you don't want a refund, because you don't want SARS knocking on your door. So it's not illegal to do that, it's just a good planning. You didn't have the invoice at the time. Right? The problem from a SARS perspective is policing it. So when they're reviewing a current VAT period and you've got an October 2023 invoice in it, how do they know you didn't claim it then? Right? I know for the few clients that we've dealt with similar queries, we show them, look, here's October 23, we didn't claim it in that period, right? We're claiming it now. But then there's a whole host of periods in between. How do they know you didn't claim it in any of those in-between periods as well? Very difficult to actually pinpoint whether something's been duplicated. So the proposal is an interesting proposal. The proposal says that if you want to claim an invoice, you need to go back to the original period to which it belonged. So if it was an October 2023 invoice, you have to claim it in the October 23 period. Now how that will work practically, I'm not sure, because if any of you tried to reduce a VAT assessment, so if you submitted a VAT return and you want to now increase your input VAT and reduce your liability or claim an additional refund, SARS does not process it. Right? It just, because it only recognizes increased VAT payments and not decreased ones. Right? So a system change is required. And then who's going to audit that? So it means, you're going to keep going back to old periods, reopening. You could reopen a period maybe 10 times. Every time you get an invoice at a later date, you're going to go back and reopen a period to which that invoice applies. So I think it's a bit impractical. So they'll have to update the system. There's no news on whether SARS will pay interest on that, because you should have claimed it in an earlier period and you didn't. Unlikely. I can't see them wanting to pay interest on it. They're very reluctant to pay interest on refunds. So interesting to see how this works. I just can't see how it's going to work in practice. I think they're concerned about duplicated claims, but the problem is, you're going to have forever opening periods to claim invoices in the correct period. Yeah, that's right, but I think there's Mike.
Just on that proposal, what if it's like 2 years ago, the financials are finalized? It makes it even more interesting.
Yeah, well, I mean, you're revising that period in the current year.
Yeah.
So I think for financial statement purposes, you probably would say you lodged the claim in the current year, you could probably record it in the current year. But, from a SARS point of view, I mean, you could end up revising your VAT return many times. But I can't see SARS, how they're going to police that. The one possibility one of my colleagues mentioned is that maybe they will reduce the 5-year period in which you can claim your input back to a shorter period of time. which is a possibility, which is not good for taxpayers either. Then moving on to other amendments. The one is related to the Mudaraba Islamic financing arrangements. I admit on this one I'm a bit confused. I'm not exactly sure how it's going to apply. So remember, Mudaraba is primarily used by Islamic banks to take deposits. Right? And if you're taking deposits, usually you're taking those deposits in cash. There's no cash VAT implications there. It's not like a transfer of an asset or so that's taking place. So at the moment, there's nothing in the VAT legislation that covers Mudaraba arrangements. There's for Muraba transactions and diminishing musharaka, yes, there is a specific VAT legislation for it, but not for Mudaraba arrangements. So I'm not exactly sure what the changes are related to. If it's not related to deposit taking, maybe it's to do with the sharing of profits and paying back profits to your deposit holders. I'm not exactly sure what the VAT problem is that they're trying to fix here. But the idea is for them to have some kind of VAT amendment that covers Mudaraba arrangements in the VAT legislation. Shabir, I don't know if you know what the issue is.
Maybe it's because if it's profits, there should be VAT on profits.
But the profits are deemed to be interest.
Yeah. Then why?
It's deemed to be. Yeah, it's very confusing. I wasn't sure, but I don't know if it came from industry. Someone from the industry asked for it. Yeah, so that was an interesting one. Then on educational institutions, remember many higher education institutions or education institutions in general qualify for VAT exemption on educational services. And the question is if those educational services are supplied to a third party and not directly to the student themselves, would the exemption still apply? So there is a bit of debate about whether the exemption applies or not, and I think what they want to do is make sure that in the legislation they provide clarity for this. I can tell you I've dealt with a few educational institutions and the laws are not clear-cut at all as to what exactly the exemption applies to. Then regarding the VAT on imported services, right? So imported services, it's not something that affects all taxpayers. It really only affects those taxpayers that are not vendors or have made meat supplies. So for example, like a bank, where you have partially, the taxable supplies and partially exempt supplies. And on imported services, that then arises. The problem is with the timing. So usually, from a timing perspective, you're required to declare that VAT on imported services within 30 days of either the invoice being issued or the payment being made. Right? And because these are sort of not normal creditor payments, sometimes that time period is not adhered to. It's usually a problem, I can tell you that. So the proposal is to extend the time frame to 60 days. So you've got 60 days to make that important VAT adjustment in your VAT returns.
I think this one makes perfect sense.
Yeah.
Because the invoice is dated now and you don't claim it, or you don't pay the VAT.
You don't pay the VAT.
So you've got to pay a penalty.
Yeah.
It should be 60 or even longer because...
Well, I mean, I think at the minimum, you know when you paid it, right? So, that should be, at worst, your trigger point. But it's the earlier of that's the problem. The invoice could have been issued like 2 months ago and you're only paying it in the current month. That's where the problem is. Then on carbon tax. So carbon tax applies to your really large emitters of carbon. I've got one client that has to pay a significant amount in carbon tax. It really adds to your cost, the cost of your product. Now, where the normal taxpayers do see the effect is in the cost of the product you're acquiring. So if you're acquiring cement, included in there is a cost for carbon tax as well. Right? So currently, the rate, or last year, the rate per ton was 159 Rand a ton of carbon emitted. This year, that rate has moved to 190 Rand, which is not a terribly high increase in comparison to where they want to be. So the idea in last year's announcements was that they wanted to be at $20 per ton by the end of 2025. That's the end of next year. So it means $20 a ton is about what, 380 Rand a ton. So the expectation is carbon is going to double, the cost of emissions is going to double by the end of 2025 and reach $30 per ton by 2030. So you can just imagine what that's going to do to the cost of certain of our commodities. Right? I don't want to pick up too much, except to say that for those companies that do participate in what they call the carbon budget, so they provide a budget to the Department of Forestry, Fisheries and Environment about how much carbon they're going to emit. If they miss those targets going forward, the cost for the excess will be 640 rand a ton they're going to have to pay, and those costs are going to be passed to the consumer. So the big emitters that I'm thinking about are like your ESCOMs, the Sasols, those kind of guys, where it's very difficult for consumers to actually dodge the cost of that carbon tax when it's priced into the goods that they're purchasing. Then on the fuel levy side, there was good news. The general levy and the road accident fund levy didn't change, so one good thing at least. The carbon tax on fuel has increased though, petrol by 1 cent a litre and diesel by 3 cents a litre. And that's effective on the 3rd of April 2024. As a percentage of the pump price, it's still a significant amount that we're paying in taxes. So almost 30% of your fuel price goes towards taxes. So it's still a significant chunk. Then, of course, this is not really relevant to this audience, I hope. Excise duties on wine, beer, and spirits are going up, but that's usual. And then on cigarettes and pipe tobacco and on vaping products going up as well. I think people in this industry have been lobbying Treasury quite hard because the legitimate players are paying the tax, pricing their products accordingly, and are getting hit by the illicit economy. And we're seeing it a lot in the tobacco industry. So, yeah, I don't know. I think it's going to push more people to go towards illicit product rather than your mainstream products. There are other miscellaneous taxes. The sugar tax, no increase, but that was expected from last year's announcement. For the plastic bag levy, that's going up. We do have in our community quite a few plastic bag manufacturers, unfortunately 1 or 2 that got themselves into trouble as well by swiping the plastic bag levy. But the levy is going up by 4 cents a bag. We do have incandescent globes that are going up as well, so it's really becoming too expensive if you have to pay the tax. Becoming too expensive to actually use normal globes. You have to use your energy savers. And then the vehicle emissions tax is going up as well. And these are the interesting ones. So this is for tax administration. So there's 3 interesting proposals that have been made. For any of you that have formed a new company recently, well, I'm sure many of you have. If you form a new company, you appoint the directors, and you get your income tax number immediately. Unfortunately, at SARS, the public officer is not automatically appointed. You've got a month's grace in order to appoint the public officer. And in effect, until the public officer is appointed, if you are following the system legitimately, it's going to take you a while to get your VAT number. Right? Of course, if you're buying it from someone down the road for 20 grand, certainly into the system, I'm talking about the legitimate way of doing things. You have to get your public officer appointed first, then follow the process of getting your VAT registration done. And it's potluck. Your public officer registration could take 2 days. It could take 40 days. It depends which black hole of space it goes into. So the one thing that's been changed that I think is going to be quite nice is at the point where the new company is registered, the public officer is going to be appointed immediately. So you don't have to go through a separate appointment process with SARS. So you can go to SARS and get your VAT registration done pretty much from the time the company is registered. So that's quite nice. The second change, SARS wants the power to require a person to attend the offices of SARS in person to be interviewed by a SARS official regarding their tax affairs. Right? So they want the ability to compel you to come and visit them. Right? So that's a change that I thought was quite interesting. And then the last item is related to ADR proceedings. If any of you have taken any matters on appeal, you'll know that sometimes it takes quite a while before SARS firstly even acknowledges whether it's suitable for ADR, then appoints a legal representative or a facilitator, and it could take any number of weeks into months before you have an ADR appointment. Often a lot of these kinds of disputes can be resolved earlier in the process if you have some kind of third party looking at the issue up front. Right? So the idea here is to maybe bring ADR proceedings further up into the, maybe earlier on in process, maybe at an objection stage. Because remember, when you're at an objection stage, you are still dealing with the SARS auditor. Right? The same SARS auditor. And their KPIs, and I think the KPIs are pretty much the same as when Bruce, Anushka and I were there, is that if you raise an assessment, it goes towards your KPI. If you reduce an assessment, it reduces your KPIs. So the incentive is there to always disallow an objection. Right? So at an objection stage, you do want a sort of disinterested party to have a look at whether the objection should be allowed or not. And in a lot of cases, a lot of these things can be resolved amicably at an earlier stage instead of going through the whole appeal process. So I think it's a good thing. My only concern is whether SARS is going to have enough manpower. Because as it is, it takes so long to get a legal representative on an ADR matter at an appeal stage, and it's far fewer matters at that point. There's far more objections to deal with. So whether they're going to have enough people to allocate a legal representative to have a look at it at that stage. It would be a good idea, but I don't know if they're going to be able to do it practically. And then the last thing, the IRS requires that you report your income from illegal activities and stolen property in your tax return. When I saw this on Twitter, okay, now it's known as X, when I saw this on Twitter, I thought to myself, would people actually fill this in? And then I saw the successive comment, the next comment said, it's not for people to actually fill it in, but if you didn't fill it in, it's for them to arrest you for tax evasion. I thought actually that's a good idea. Remember Al Capone was caught out for tax evasion and not for criminal activities. Maybe we should implement something like this in South Africa. Right, and that's me. Thank you. Any questions? Your last chance to get free advice. In 5 minutes, I start charging. My rates have gone up. Is that it?
Very optimistic budget in terms of collection.
No, I just think it was sort of walking that fine line. Walking that fine line. It wasn't optimistic, it wasn't pessimistic, it was just there to try and keep it in balance. That's what I think.
And the whole section 45 and restructuring, no changes.
Yeah, but I just didn't go through them in detail. So as I said to you, there's a lot of changes in the budget. So aside from the ones that I spoke about, on the corporate tax side, there's about maybe 10 more amendments. A lot to do with corporate rollover relief, with all your structured finance kind of arrangements, things like that. And then on the VAT side, there were a whole host of amendments related to non-residents and things like that. So,
you think that extra 100 billion for individuals will come from them finding more taxpayers or from the existing taxpayers?
the existing ones, of course. Now, I mean, you could see from last year, the number of taxpayers that are actually paying any tax, which is increased by 300,000. So from that additional 300,000, are you going to get 100 billion rands in revenue? It's from the existing base that they expect they're going to get more out of.
That's also interesting because in the previous years, the number of taxpayers was reducing. Now
it wasn't reducing. It was just like a constant, like almost like 10% of the population. So the population is increasing a bit, but it's still a very narrow base of taxpayers. If you think of a population of 70 million people, only 7 million people actually pay any tax. That's very small. It should ideally be wider than that.
Are they going out to collect tax from an administrative point of view? All the systems and artificial intelligence and all those, is that all happening or is that all this nonsense?
So look, I mean, SARS has a lot of information at their disposal, and we've had it for years. When I was at SARS, we had IT3B information. You had information of, from the e-native system. You had information as to the high-value properties that changed hands. So we had that information. The problem is matching that information to your taxpayers. And I don't think that's been done properly. So even when it came to, you remember, maybe 5-6 years ago, they were talking about the Panama Papers, and they put out warnings to say, you know what, we know who you are, we're coming to get you, do a voluntary disclosure in advance. I haven't heard of many people being caught under those Panama Papers things, simply because, I don't know whether it's a system thing or whether it's a manpower thing. It's hard for them to join the dots. The information is there. If you think of Al Baraka Bank, when you submit your IT3B information to SARS, you're not only submitting information on the interest or the profit that's been paid, you're also submitting information on the total credits and debits that go through each person's account. So SARS knows on a gross basis what's going through your bank accounts. So all they have to do is compare the credits to your income, pick up those that are big anomalies and ask, why did you get so much money into your account but your income is so low? Huh? They are starting to ask questions, but I don't think enough. That needs to happen.
Just on that, I had a client who had a query just last week. You've got 10 million in this account, you've got 5 million in that account, and you've got 2 million in different 3 banks you have. And they wanted to know, you haven't declared the income in your tax return. Where did you get the money from? Because the banks are reporting those balances all the time. Yeah. And the second question they asked him was, you are a director of all these companies. What director's fees did you earn from these companies? Why haven't you declared any of the director's fees? So exactly what you're saying is already happening.
It is, but not enough.
Well,
that information, a lot of information was available for many years already.
Yeah.
You know?
But when I refer him to an accountant to handle it, the accountant says he's getting quite often these kind of queries because they got the information.
Okay, so maybe they've got the crooked clients. Sorry to say. Look, I mean, some of the anomalies are perfectly legitimate, you know, loan account movements, movements of intercompany, inter-account transfers, things like that, perfectly legitimate, you know. But you have to ask the question.
That you guys are reporting monthly balances.
Every 6 months?
Yeah, but it's monthly balances that...
Every 6 months. Yeah, but you report the monthly balances every 6 months.
Yeah, it's monthly balances.
There's a trend. You supply over trend.
Yeah.
Actually, you can actually see that in your e-filing profile. If you go to third-party data, into the bank account, you can actually see your bank account movements for the month, credits, debits. It's there already.
Yeah.
On e-filing, third-party data.
Yasmeen, is SARS keeping up with technology?
I think so. I look, they are certainly investing a lot more. If you, earlier on I mentioned about VAT modernization, payroll modernization. They want more real-time information. Right? The unfortunate thing, I think, is that they're really policing the base that's already registered. You know, so so that modernization, they went to implement it for your top 20% of the vendors to start with. The top 20%, your top, your biggest companies, usually those guys shouldn't be too bad from a compliance point of view, right? Maybe they make errors, maybe there's a technical issue, whatever. But generally, you're going to get your revenue from those people, right? The people that are not on the register is the problem, and I think that's you shy away from doing what's hard. I think they're over-policing the people that are on the register and they're not necessarily looking for what's omitted. That's the problem. And that's harder work to do.
Just a sincere thanks to our guest speaker. I can just ask our COO, Mr. Mohammed Kaka, just to present a small token of appreciation to our speaker.
Make sure you declare that.
Last year the present was bigger. No, I mean inside.
Everyone on Instagram saw that, right? You made the comment.
Yes, we'd just like to say our sincere thanks for our speaker, Yasmeen Suliman, for that very insightful, detailed discussion. I think it's evident that with that